Unleashing economic growth through tax reform. Imagine sitting across from Jamaica's Prime Minister, the Right Honourable Dr. Andrew Holness, who has the power to reshape Jamaica's tax system. What would you ask him to change? Would you push for lower tax rates, a simpler process, or more fairness in enforcement? For many business owners and financial professionals, Jamaica's current tax structure poses significant challenges. But what if some of the biggest tax burdens could be reformed? Here are recommendations that can make Jamaica's tax system more efficient, fair, and growth-orientated. Number 1. A fair withholding tax for non-residents. Currently, payments to non-residents attracts a very steep default withholding tax of 33.33% for companies and 25% for individuals. Since withholding tax is applied to gross payments, this results in a heavy tax burden, especially when transactions involve non-treaty countries. Let's say that your net profit margin, net profit as a percentage of sales, is 50% of your gross income. A 33.33% withholding tax equates to an effective income tax rate of 66.67% on your net income, which is excessively high. A more balanced approach would be to reduce withholding tax across the board to 12.5%. This rate aligns with reasonable tax assumptions, assuming a 50% profit margin and a 25% income tax rate. Withholding tax would equate to 12.5% of gross income. By setting a fair and predictable withholding tax, the government could reduce the incentive for companies to use offshore structures, while ensuring that more taxable income remains within Jamaica. A lower withholding tax rate might actually lead to greater tax compliance and increased revenue collection, benefiting both businesses and the country. The current high rate of withholding tax is almost forcing overseas companies that want to provide services to Jamaica to set up CARICOM intermediary companies in order to avoid the otherwise insanely high tax burden. When an overseas supplier sets up an intermediary company in a CARICOM country like St. Lucia, it benefits from significantly lower withholding tax, which allows it to save enough money to justify investing in St. Lucia instead of Jamaica. This shift benefits St. Lucia's economy at Jamaica's expense. Number 2. Leveling the playing field for regulated entities. Regulated businesses, particularly in the financial sector, face a 33.33% corporate tax rate, significantly higher than the 17.5% effective tax rate that unregulated companies enjoy due to the employment tax credit. This creates 3 major problems. Number 1. Barrier to entry. High tax rates deter new businesses from entering regulated industries, reducing competition. Number 2. A penalty for scale. Larger companies, which are often the financial backbone of the economy, bear a disproportionately high tax burden. These companies, when publicly listed, consist of thousands of small shareholders, who collectively own a massive entity. This does not justify the significantly higher tax rate imposed on them. Number 3. Overburdening key industries. Instead of penalizing our financial institutions with excessive taxation, we should incentivize them to grow and compete more effectively on a regional and global scale. Lowering the income tax rate for regulated entities would remove these disincentives and be a game changer for Jamaica's financial sector. The Jamaican financial industry could become more competitive in comparison to regional and international peers. A more competitive market would lead to increased efficiency, lower costs for consumers, and better access to capital for businesses. Moreover, it would allow financial institutions to offer better returns to investors, potentially driving more investment into the local economy. Number 3. A time limit on income tax objections. In Jamaica, businesses that file general consumption tax objections are guaranteed an expedited review process. However, income tax rejections often remain unresolved for years, leaving taxpayers in limbo and subjecting them to prolonged financial uncertainty. A simple solution would be to impose a 6-month time limit for Tax Administration Jamaica to issue a decision on income tax objections. If TAJ fails to meet this deadline, the assessment should be deemed null and void, just as with GCT objections. This reform would reduce bureaucratic delays and create fair treatment for taxpayers, prevent financial strain on businesses tied up in unresolved disputes, and improve confidence in the tax system, encouraging greater compliance. The bigger picture, a tax system that works for Jamaica. Each of these proposed changes is more than just a tax cut. They are strategic reforms designed to stimulate economic growth, encourage increased compliance, and create a more competitive business environment in Jamaica. By making Jamaica's tax system fair and more efficient, the government could attract more investment, support business expansion, and ultimately grow the economy in a way that benefits all Jamaicans. The 2025 budget debate is scheduled for March 11, 2025, making this the perfect time to advocate for tax reform. We would love to hear from you. What are your top 3 recommendations for tax reform, and what do you think about ours?